Gold. It hasn't failed anyone in 5,000 years. But what about you? I don't know how much you've saved up to this point. Maybe you have a retirement account, an index fund, or perhaps those tech stocks you trust so much. But I want to ask you an uncomfortable question. 100 years from now, will your great-great-grandchildren look at those assets and be able to say, these still hold value? Because what I'm about to show you will likely change your perspective on money forever. No one can predict the future. However, for 5,000 years, gold has answered this question the same way. Yes, and the reason why is something almost no financial advisor clearly explains. In this video, I will explain why gold isn't just an ancient metal, but one of the most strategic tools in a modern portfolio. We will examine inflation, crises, central banks, and the question everyone is asking, is it too late to buy gold? Stay with me, because toward the end of the video, I will show you that a specific moment when people throughout history realized they truly needed gold. The 5,000-year stress test. The strange thing is, every society trusted its own money until it didn't. First, empires collapsed. Then, currencies vanished. The Roman Empire fell. The Ottoman Empire dissolved. The Soviet Union became history. Their currencies are now nothing more than museum pieces. But what do you think happened to the gold coins from those eras? They still retain their value, because the value of gold is not political. It is physical. In ancient Rome, 1 ounce of gold could buy a high-quality toga, the traditional garment of the time. Today, that same ounce of gold buys a high-quality, custom-tailored suit. The world has changed, but gold's purchasing power has remained the same. This leads to a dangerous question. If gold remained stable, what actually changed? Was it the gold, or was it our money? Stocks fall, companies go bankrupt, governments default on debt, but gold always remains. Inflation, the silent wealth transfer. Inflation doesn't explode overnight. It rises slowly, silently, and continuously. Most people lose their wealth exactly this way, bit by bit, but relentlessly. In 1971, Nixon severed the dollar's link to gold. At that time, gold was $35 an ounce. Today, it is over $2,600. This figure isn't telling you that gold got more expensive. It's telling you that money got cheaper. If you had left $35 as cash, it would still be $35. If you had bought 1 ounce of gold, its value would have multiplied. In 1971, the average American home was about $25,000. Today, it's over $400,000. Yet when measured in gold, housing prices haven't actually soared at the same rate. The dollar weakened. Gold protected itself. Gold does not get crushed by inflation. It combats it. In the end, gold has always been the winner. Once you understand this, you start noticing it everywhere. At the grocery store, in your rent, in energy costs, in everything. 2008, when the system cracked. September 2008, Lehman Brothers collapsed. The S&P 500 fell by a total of approximately 56%. Retirement accounts were decimated. Panic was everywhere. And at that exact moment, gold began to fulfill its very purpose for existing. Gold initially dipped for a short period, but shortly after, it skyrocketed. From around $700 before the crisis, it broke $1,000 and eventually reached around $1,900. While stock investors waited years just to break even, gold owners preserved their purchasing power. That is the function of gold. Not excitement, not speculation. Survival, 2020. Global panic, March 2020. Markets crashed at record speed. The S&P 500 lost about 34% of its value in weeks. Gold also saw a brief dip, but then it surged past $2,000 by August, breaking all-time record. While people were afraid to leave their homes, investors were running toward one thing: gold. A different century, but the same human reaction. For thousands of years, in moments of extreme uncertainty, capital has always flowed into gold. What gold is and what it is not. Let's be honest, gold is not a growth engine. It doesn't innovate. It doesn't pay dividends. Warren Buffett criticizes gold, saying it just sits there. At first glance, that sentence makes sense until you understand what gold is actually competing against. Gold isn't competing with Apple stock. Gold is competing with currency risk. It is an insurance policy, a stabilizer, a financial shock absorber, and you only notice a shock absorber when the road gets rough. Why do central banks keep buying gold? Here's a question most investors ignore. If gold is an outdated relic, why have central banks been buying it so aggressively in recent years? Governments very rarely do anything by accident. China, India, Poland, Singapore, they are increasing their gold reserves, not decreasing them. Why? Because gold is neutral. It cannot be printed. It cannot be frozen. It isn't tied to a single political system. When central banks diversify into gold, they are sending a powerful message. Trusting paper alone is not enough. And they aren't saying this in speeches. They are saying it with billions of dollars. Physical gold versus paper gold, saying buy gold is simple, but how you buy it matters. In a normal market, paper gold and physical gold look identical. In a crisis, the differences emerge. With physical gold, coins or bars, there is virtually no counterparty risk. ETFs are liquid and convenient, but they are financial instruments. As for mining stocks, they offer leverage, but they also bring company a specific risk. Most balanced investors use a mix of these. However, history shows that in extreme moments, the distinction between paper and physical gold suddenly becomes very clear. So, is it too late? People ask this when gold was $280. They ask at $700, at $1,200, at $1,600. They always ask the same question right before the uncertainty begins. Gold moves in cycles. It can experience sharp drops. It lost about 40% between 2011 and 2015. But gold is not a trading tool. It is insurance, and you never buy insurance after the fire has already started. Most strategists suggest allocating 5% to 15% of a portfolio to gold or similar safe haven asset. This won't make you rich overnight, but when everything else is burning, it gives you room to breathe. Why does gold endure? Gold is hard, it is durable, it is universally recognized, but the deepest reason it survives is psychological. Humans fear the loss of value in money. They fear instability. They fear losing control over their savings. Gold has always been the answer to that fear. Cryptocurrencies may eventually evolve into digital stores of value, maybe, but gold has already passed the ultimate stress test over a lifetime of civilization. If you remember only one thing from this video, let it be this: gold probably won't make you rich. However, almost every financial disaster in history has created one common group of people, those who wish they had bought gold sooner, because gold is not a gamble for profit, it is a precaution against regret. If this video changed your perspective on your financial future, don't forget to click the subscribe button and turn on notifications to join us on this journey. So which safe haven asset is in your portfolio? Gold, cash, or digital assets? Let's meet in the comments. I read every single one. See you in the next video. Follow us for financial freedom.